Modern algorithmic markets operate through rapid price oscillations that occur thousands of times every second across the exchange. Continuous rebalancing causes leveraged ETFs to mathematically decay throughout every trading session. To understand the economic impact of path dependency, consider a theoretical baseline index moving smoothly from $100 to $102. In this scenario, a 3x leveraged ETF tracks the move with exact precision. A path with zero volatility allows the leveraged product to deliver a clean 3 times return with minimal friction. Reaching that same $102 destination via a highly volatile path creates a different outcome. While the index arrives at the same spot, the 3x ETF diverges downward, ending significantly lower due to the accumulated decay of the erratic path. Volatility destroys leveraged value through the mechanism of path dependency. The trajectory of a price move carries the same economic weight as its final destination. While retail investors view this decay as a long-term risk, institutional trading desks treat it as a daily structural reality. Maintaining a constant leverage target requires an ETF sponsor to execute trades that effectively buy high and sell low. This continuous friction generates volatility drag. Continuous time stochastic calculus allows for the precise, rigorous quantification of this volatility drag as a deterministic mathematical property. Institutional execution algorithms can position themselves to capture this predictable decay intraday, long before the broader market prices it in at the 4 p.m. close. Measuring this extraction requires leaving standard finance models behind and entering the domain of continuous time mathematics. We begin by assuming our underlying asset price follows geometric Brownian motion, or GBM. Geometric Brownian motion is a continuous time stochastic process where the change in the logarithm of the price follows a normal distribution. The equation partitions the asset's movement into predictable directional drift and a random volatility shock. Our instrument is a self-financing leveraged portfolio that maintains a constant leverage ratio, represented by the variable L. To find the true dynamics of this rebalancing portfolio, we must apply Ito's lemma. Ito's lemma is a mathematical identity used to find the differential of a time-dependent function of a stochastic process. This requires calculating partial derivatives with respect to the underlying price, specifically focusing on the second derivative. Substituting the original GBM components into the Ito formula results in the expanded differential equation for the portfolio value. The quadratic variation term at the end of the formula is the focus of the derivation. In stochastic calculus, the squared differential of the price process resolves to variance times time. This second-order term isolates the specific cost generated by continuous intraday rebalancing. This isolated second-order drift term represents the core of the extraction strategy. This term provides the mathematical definition of volatility drag. We can further simplify the equation by defining the Greek letter kappa as exactly 1/2 of the leverage squared minus the leverage. For a 3x leveraged ETF like TQQQ, the kappa multiplier is 3. The final drag equation reveals that the instantaneous cost is 3 times the variance over time. Since kappa is positive for any leverage above 1, and variance is always positive, this drag is strictly cumulative. Volatility makes decay a mathematical certainty. Integrating this drag over a standard trading day shows the total accumulated decay. The curve starts at 0 at the market open and rises continuously as the trading session progresses. This curve represents a pool of structural alpha that exists within the mechanics of the market itself. The broader market is efficient and attempts to price in this decay as it accumulates throughout the day. The net extractable value equation determines the portion of the decay that remains available for capture. The rho variable represents the market's pricing fraction. Near the 9:30 a.m. open, rho is low, but by the 4 p.m. close, the market becomes highly efficient, pricing in nearly 95% of the total drag. Optimal extraction occurs in the mid-morning window. At this point, significant decay has accumulated from opening volatility, but the market's pricing fraction remains unadjusted. The final variable, eta x, represents execution efficiency. Actual trading introduces frictions like slippage and spread that must be managed against the theoretical edge. Even a perfect mathematical setup fails if the execution infrastructure pays more in slippage than it captures in structural decay. Real-world liquidity constraints dictate the success of the strategy on the trading floor. Extreme market stress causes the bid-ask spread to widen. During these periods, transaction costs can grow to exceed the available structural alpha. We monitor order flow imbalance, or OFI, to detect these toxic conditions. Order flow imbalance is a measure of the net difference between buy and sell volume at the best bid and offer prices. Sustaining a strategy in these conditions requires an algorithmic enforcer of positive expected value, known as the decay to slippage ratio kill switch. This gauge tracks the ratio of expected alpha to observed slippage. If this ratio drops below 1.5, the system recognizes that edge conditions have deteriorated and instantly halts execution. Within this framework, positive expectancy functions as an algorithmically enforced real-time law. The COVID crash of March 12, 2020, provides a historical benchmark for this mathematical model. On that day, the VIX spiked to 76, while institutional liquidity collapsed from $8 million to $3 million. As slippage risk grew, the decay to slippage ratio plummeted to 1.4, triggering the kill switch and instantly pausing all execution. Suspending execution allowed the system to avoid an estimated 18 basis points of loss during the flash freeze. Algorithmically refusing execution during a regime break is as vital to portfolio survival as capturing alpha in stable conditions. Institutional power is derived from the implementation of heavily bounded deterministic systems. Optimization requires integrating continuous time calculus with the practical constraints of market microstructure. The ultimate institutional edge comes from engineering deterministic infrastructure that guarantees the cost of extraction remains below the mathematical advantage.